Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastop Jr.
Welcome back to the Ask Ralph Show. You know, one of the questions I get a lot from clients is whether they should invest in a pre-tax retirement account or a Roth. Now, I have to be honest with you, my bias starts early with this. I've never been a huge fan of the Roths. If those of you who don't know what a Roth IRA is compared to a traditional, a Roth is an IRA that you contribute to with after-tax money. And the money grows tax-free, and so long as you keep the money in for a minimum period, you can take that money out without any tax consequence. Now, so this comes across a lot of times. You know, anyone who's saving for retirement has probably had to decide whether to save in a Roth account or a traditional retirement account. Now, experts commonly recommend that you save in a Roth account if you expect to have higher income in retirement than you do now. That's because you pay taxes today on Roth contributions, but don't pay taxes on withdrawals in retirement. And higher incomes are generally associated with higher taxes. There's a caveat to this, though. However, if you're already saving for retirement and you intend to maintain the same standard of living when you leave the workforce, then your retirement income won't likely exceed your current income. Moreover, there's more to the equation than the difference between your current income and your potential retirement income. A traditional 401k or IRA may allow you to save more and thus grow your retirement savings faster, especially if you're investing primarily in stocks. So one of the things we're going to talk about today is don't tilt the math in favor of Roths. One could argue that savings taxes at your marginal tax rate today on a contribution of $5,500, that's the maximum IRA contribution for 2018, is worth less than the tax savings on your withdrawal during retirement. After all, you're likely to withdraw a lot more in a year than your annual contribution. Let's look at a perfect example of this. Let's give him a name. Let's say his name is Adam, with a net income of $65,000 per year, is firmly in the new 22% tax bracket. That's a 2018 tax brackets. If Adam maxes out his Roth IRA contribution, he's effectively paying $1,210 in taxes each year that he could have kept out of the government's hands by saving through a traditional IRA. So what we're saying here is that you put that money into a Roth, you're putting it in with after-tax money. So it's effectively costing you $1,210 in taxes for this person in a 22% tax bracket. But if Adam needed $30,000 from his Roth IRA each year in retirement, then he'd save at least $1,970 in taxes on the withdrawals, assuming tax rates remain the same when he's retired. Indeed, one of the benefits of a Roth account is that you're never taxed on the growth of your contributions. But in that exercise, we've tilted the math in favor of the Roth account. So let's talk about why that is. So here's the right way to compare a traditional and Roth contribution. So this is where it's time to take notes, because this is something that a lot of need to think about and need to take a look at. When Adam saves $1,210 in taxes by using a traditional IRA, he doesn't just blow that cash on stuff he doesn't need. Since he's smart, he puts the money in a taxable brokerage account. Assuming he invests those tax savings each year until he retires 25 years from now, and the money earns an average return of 7% annually, he'll have an additional $76,500 to his name. When it's time to pay taxes on his traditional IRA withdrawals in retirement, he'll have plenty of money to do it with. So, granted, Adam will have to pay taxes on the gains in his brokerage account. That's the bottom line, because you're using pre-tax money, but the U.S. government really wants people to invest. So it has very favorable long-term capital gain taxes. There's even a very generous 0% tax bracket for long-term capital gains depending upon your income. As long as Adam's total taxable income is below $38,700, assuming he's single, or $77,400, if he got married, he'll pay no taxes on long-term capital gains in his brokerage account. What you'll find is that the math almost always works out in favor of a traditional retirement account compared to a Roth account, as long as, number one, you invest your upfront tax savings. So that's the key. If you're saving money by putting money into the IRA, the taxes that you're saving, you need to invest those. Number two, your standard of living won't dramatically increase in retirement. And number three, federal income tax rates stay more or less the same. Now, of course, that's the who knows question. Now that we've talked about, the best time to use a traditional, let's talk about the best time to use a Roth. While I think most people are better off saving in traditional retirement accounts, there are always exceptions. So let's talk about some of those exceptions. If you already have a marginal tax rate of 0, then you should probably definitely save money in a Roth account. What we're talking about here is if you don't have that much in taxable income to where you don't even pay any taxes, a pre-tax IRA is of no value to you. One of the things that, I've had this happen to clients, when they're in a particular tax year and their income is very low, even though they put money into a traditional IRA, a 401k, it resulted in a 0 tax bill. So especially if you've got a lot of kids and you get a lot of tax credits for them, a Roth could work out better in your situation. That's assuming that you're going to have income in retirement that's going to put you in some tax rate. At the 10% marginal tax rate, it's a close call. So if it's a 0% tax rate, it's really a no-brainer to go to the Roth. If you're at a 10%, it's a close call. And the tax benefits of traditional contributions are practically nothing for most people. It might make sense to save in a Roth account and thereby lock in the 10% rate or even a 12% rate as a hedge against potential tax increases in the future. Also, if you expect to have significant additional income in retirement outside of your retirement accounts and long-term capital gains, you may want to use a Roth account to lock in income at the lowest tax brackets if you can. If you don't qualify for a traditional IRA deduction, then you should definitely put money into a Roth. So if you're one of those people that we do your taxes and you don't qualify for a traditional IRA, then it's a definite to do a Roth. The IRS phases out the traditional IRA deduction as your income increases, and there's little benefit to a traditional IRA without the tax deduction, and that's the key. The government prevents you from contributing directly to a Roth IRA if your income gets too high, but you can still execute the backdoor Roth contribution with an after-tax contribution to your traditional IRA. And I'm not going to talk about that. It gets very complicated. It's a little bit too much for this show. Now, finally, remembering that saving in a Roth account is still better than saving in a taxable account. You'll be able to buy and sell stocks without worrying about taxes on capital gains and dividends. And you'll be able to withdraw your gains tax-free regardless of your income in retirement. Ultimately, at the end, every person's situation is different. The things I've talked about here may not pertain to every individual. You may need to do some homework to get a complete picture of your financial situation, but it can save you thousands of dollars in taxes over the long run. This is where I say it makes sense to talk to an accountant, to a financial planner, because the key is that you want to max out your retirement, whether it's from traditional IRAs, 401ks, or Roth IRAs. You want to make sure you're putting money away for retirement, and you have to do it wisely. And so that's why I wanted to spend some time today talking about the difference between, the traditional IRA and the Roth IRAs, because there's a lot of people out there, spreading a lot of misinformation. And you have to just remember that it's not a one-size-fits-all situation, because your situation is different from your neighbor's situation or the person you work with. So I hope this was helpful, talking about traditional versus Roth IRAs.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.